Let's Talk Venture is a webinar we host, which is designed to help people better understand the venture capital landscape, answer all of your questions, and so on and so on. And so my name is Mike Supervici. I'm the head of acceleration here at VC Lab. I'm also joined by Adeo, who's the CEO of VC Lab. And if this is your first time joining one of these events, we do these every single week. And we do them to try to help and to try to answer as many questions as you may have about venture capital, about the industry, about how things are going and all that other stuff, and to really try to help you with your strategy if you're considering joining a venture capital firm or launching a venture capital firm. So, don't hesitate to ask questions. Before we kind of introduce VC Lab and everything else, just a couple of things here. Introduce yourself in the chat here. There's like a webinar chat on the right-hand side of your screen. Say your name. Hi, Eric. Good to see you. Put your LinkedIn in there. Just don't mention kind of like your thesis or what you're investing in or anything like that, because that's a potentially general solicitation. So don't put that in the chat. And if you have questions for Adeo and I, there's a Q&A button at the bottom of your screen. And so at that, go ahead and select that and upvote those questions, because we will be highlighting trying to answer all the questions that you have. So make sure that you do that. Looking forward to spending this next hour with you. Adeo, do you have any thoughts?
Yeah, we definitely look forward to your questions. So why don't I just introduce VC Lab quickly, and then we can get started with the questions. So this event is for any questions on venture capital. It's run by Mike and I. Mike and I have together now helped launch roughly 350 firms all around the world, from fund ones to fund threes. And so we know, and beyond. And so we know a lot about what it takes to launch a venture capital firm in 2023. Right, we may even be two of the top experts in the world. So what VC Lab is it powers emerging managers to launch enduring and impactful venture capital firms. And we have 4 groups to what we offer. First is the lab. And that's where we do lots and lots of free things to help the venture capital community worldwide. We have a free accelerator. It launched roughly half of all new manager firms in 2022. It's got a 92 net promoter score, and it is a fantastic offering if you are starting a new venture capital firm. We also do these events and lots of content as part of the lab. Secondly, we have something called Decile Hub. Decile Hub is a full-featured back office platform to run your venture capital firm. It has the CRM, it has digital signing, it has data rooms, deal memos, everything you need, and the whole accounting to run your venture capital firm. It is a vertical SaaS platform for venture capital, and we are releasing in this quarter a lot of really neat things for marketplaces so that limited partners can discover your venture capital firm, so that you can share deals with other venture capitalists around the world. So Decile Hub right now is the market leader. It has more firms using it month to month for back office than either AngelList or Carta. Next, third, we have something called Decile Partners. Decile Partners does the formation and back office for venture capital firms all around the world. It's fixed price, not variable price, so you know exactly what your costs are. There's no funny games that law firms and accounting firms play with venture capital firms so that you essentially overpay for these services. None of that. And that also has an 86 net promoter score. And both Decile Hub and Decile Partners are only available to people that go through the Decile Labs offerings, or VC Lab, the accelerator. So if you don't go through the accelerator, you can't get access to the tools and the back office. And last but not least, we have a fund of funds. And so obviously, if the Decile Hub and Decile Partners is only available for people that go through the accelerator, also the fund of funds is only available for people that go through the accelerator. But we're not doing it for money. We're not doing it for fame. We're doing it to make the world a better place, right? Venture capital controls the money flow of innovation. And right now, we are not focusing on things that are going to make the world a better place. We're lots of kind of SaaS models and things, and they're definitely not. I'm not saying that SaaS is bad, not at all. I mean, we built a SaaS platform, so there you go. But you know, there's carbon capture, precision neuroscience. There's lots of things that rank much more important than yet another SaaS application to do something that 100 other people are doing, right? And so what our goal is to encourage a next generation of venture capital managers who have a strong set of values and ethics, which we call the Mensarius Oath, and help them to win 2 to 5 times better than their peers just working on things that don't matter. And so that within a few years from today, if you're a venture capitalist working on something that matters, you will outperform the market so dramatically that it will be, you know, embarrassing to be kind of working on things that don't matter. And everyone will realize that we need to be working on things that matter, funding things that matter, and making the world a better place. And that's why we do this. So with that said, we're here to answer your questions about venture capital, about anything that VC Lab offers and does, and frankly, happy to discuss ethics in venture as well. Pretty much anything you want. So there's a Q&A button at the bottom of your screen. We will not be monitoring the chat. And if you pop a question into the Q&A, Mike and I will start answering it. Now, I want to say one thing that always happens in these sessions, right? You have a question right now, and you're thinking, oh, I'll answer in a moment, okay? Well, what happens is about halfway mark or so comes, and then hundreds of questions start coming in, and we have to rush to get through them. So if you have a question, put it in the Q&A, and also take a moment to update the Q&A. If you guys want, I can also show you Decile Hub if someone's really interested and that question gets some upvotes. I'm happy to show you the back office platform as well. All right, so you want to get started with some questions, Mike?
Let's go. There's a question here from Dominic. How different will the crypto cohort 1 be versus the cohort 11 program? Seems quite the same structure. So could you please talk about the differences?
Well, we have to, so if you're interested in crypto, apply by the early deadline, because we're not going to necessarily run a dedicated cohort for crypto unless we get enough application volume. And right now we're pretty close. We need about 50 more applicants to hit our internal target. Otherwise, we'll just do it as part of the normal program. If we were to do a dedicated Crypto 1 program, because there's volume, and as I said, we'll know in a few days, because that's the deadline, then it's going to be much shorter. So what we're going to do, like, look, launching first of all, everyone in crypto, like truth or fiction, likes to believe they move really quickly. So to have a 4-month program in crypto probably doesn't make a lot of sense, right? So our first thought is it's going to be 2 months, so half as long, and we're going to like leap right into some pretty big things to help people move quickly on their vision. So again, we'll know in about a week. Get your application in. We need about 50 more to hit our internal target to run it. And then the main difference will be, obviously it's focused on crypto, and it will be considerably shorter, trying to cram in a lot more stuff in a shorter period of time, which means that, people are going to have to really hustle to want to launch a firm and fund in crypto, compared to, let's say, the 4 months of the normal program, which can take a lot longer. Another thing you can do, everybody, is upvote questions in the Q&A by clicking the thumbs up, and that will help Mike and I get to the most popular questions first.
Yeah, so there's 12 questions right now in the Q&A, everyone. So if you could just take a look, maybe upvote them, maybe add a question right now. There's like a button at the bottom of your screen. Just select that. We really want to try to prioritize those that are upvoted the most. So Anna saying, thank you guys. I plan to launch a fund and would love to do it through VC Lab. I have also accepted the Messarius Oath. Curious to know, what are the fees associated with starting a fund? I've seen various different costs.
Yeah, so everything you, okay, all right. I'm gonna have to give everything you read on the internet about launching a venture capital firm or fund is BS, okay? On the off chance that it's right, which is the odds are low. Let's just say, like, I read lots of stuff on the internet about launching a venture capital firm. There's like stuff on TechCrunch, there's stuff written by people in the industry. I would say, so let's use an example of stuff on TechCrunch. I can assure you that there's no TechCrunch writer that understands even the basics of venture, and guest editors aren't that much better. So that's just, baloney. Next, you get to these managers, Fred Wilson, whomever, and, they've launched one firm, right? Congrats. Great. So they're telling you their experiences launching one firm. And a lot of them did it like 20 years ago, right? Which, like, it's very different times. So I would say, there are nuggets of wisdom in those for sure. I don't want to discount them, but, I launched one firm. Let me share everything I know about launching my one firm 20 years ago with you. It's not super helpful. So a lot of stuff you read on the internet is just garbage. Okay, just discard. I've done all this research about launching a fund. There's nothing you can research about launching a fund on the internet that would be correct. Mike?
Same with ChatGPT, okay? Stay away from ChatGPT. It's super not accurate when it comes to this kind of stuff.
Well, it's trained on crap on the internet, right? It's like, it's like, as I said, is it like in the realm of right and wrong, and there's the middle line, and this is right? It's kind of like right there. Sometimes it's a little more right, sometimes it's more wrong. It's definitely in the middle, but it's not right, that's for sure. If anything, it's leaning towards wrong. So going back to the specific questions of cost nothing, okay? You do not have to spend any money to launch a venture capital firm. Now, with that said, if you do not have money, you will almost inevitably be unable to launch a venture capital firm. So the cost isn't where the expense is. If you try to launch a fund of over $5 million, your LPs will ask you to do a 1% GP commit. Now that sounds like a lot of money in some cases, but it's actually not, because it comes out in capital calls, and you are also making money by running the firm, but you're gonna need most likely tens of thousands of dollars in some sort of savings account to meet the initial 1% capital call that you have to make as a GP. Outside of that, really, there's no expenses. Maybe you fly somewhere for a meeting, or you buy a ticket to an event or something like that to meet LPs at a conference or whatever, but you're not like spending tons of money on legal spending. That all comes out of closing costs. There are things called fund expenses, and those are reimbursed or paid for by the fund. And so you really don't need any money. The second thing I would say, though, besides that tens of thousands of dollars to meet your GP commit, and of course, if you have a small fund, you actually don't need a GP commit, so then you don't even need that, right? But then you're starting with a really small fund, and that doesn't give you enough money to live on. right? So you're going to need some savings to live on. So, it's 6 of one, half dozen of the other, whether you have enough money to meet your GP commit or you do a small fund size without the GP commit. Now, one final thing, you need to know rich people. If you don't know rich people, it's also going to be impossible to do a fund, because the limited partners are most likely going to be in your network for your first close. So if for whatever reason you don't have a network that has angel investors and people who have exited companies and stuff like that, like generally people with excess capital on hand, then it's going to be very hard for you to build a fund.
If you want to learn more about fund expenses, take a look at the link in the chat that was posted by us. We should probably cover this one little bit though, Adeo, since this is also topical. Adeo's right. If you follow the process that we're discussing in VC Lab, what a lot of people do though is that they make a lot of mistakes and do things out of order, like trying to incorporate funds and working with fund admins with aggressive salespeople that try to close you, and then all of a sudden you owe a lot of money before you do that, right? And so again, don't avoid aggressive salespeople from organizations that are trying to sell you fund admin services. Avoid spending any single time on anything related to incorporation and things like that, and just focus on trying to get LPs to commit.
Yeah, the industry is littered with disreputable organizations, even people that you're like, oh, but I hear great things about Carta or whatever. Yeah, okay. Read their engagement letter. They make it, it's a 3-year, $25,000 per year out. So once you sign it, if you decide to leave for any reason, you owe them $75,000. Like, oh, I don't want to be in venture capital anymore. Well, tough. You owe them $75,000. I mean, so the sad thing is there's a lot of predators and disreputable organizations working in venture capital today. Venture capitalists themselves are largely, in that category. Okay. And we're changing it. So we make everyone sign an oath of ethical conduct, because that's not what we're building. That's not who we are. That's not what we want to do. The program's free. It doesn't cost anything. There's no secret expense. You don't sign anything except you agree to the mensarius oath. That's it. There's no secret clause with like lots of money that you owe us if blah, blah, blah. That's not like, we're changing things. It's broken. We're going to fix it, but stay away. The lawyers, the back office providers, a lot of them are disreputable, dishonorable, and will, frankly, make you owe them money for things that you probably shouldn't have done in the first place, candidly. Okay, let's keep rolling.
LPs hesitant to invest in VC due to high interest rates and low valuation landscape.
No.
Really.
Look, you're yes and no. Okay. So big organizations like endowments, sovereign wealth funds, etc., they're like, oh, venture, we're over allocated into venture. Okay. No one on this webinar is going to pitch them in the foreseeable future, because new managers can't go after those large pools of capital, because those large pools of capital are prevented by charter from investing in new managers. And there's a lot of reasons for that. A lot of new managers have tons of drama historically. And we're changing that as well, because if you're a new manager in VC Lab and you come out the tail end, you close, right? If you're a new manager in the real world, most don't close. So you can imagine I'm a big sovereign wealth fund. I'm like, oh, I'm going to go start talking to new managers. 1 in 50 actually close. Maybe even 1 in, I don't know, Mike, what do you think? At least 1 in 50, probably more like 1 in 100.
I was going to say that it goes for 1 in 100.
Yeah, at least. Okay, so now you have 100 meetings and 1 is real. So they're just like, look, we don't want to deal with this mess, so we don't invest in new managers. So most of the limited partners that you're going to close are high net worth individuals that are first and second degree connections of yourself. That audience should get you to a 5, 10, And depending on how good your network is, maybe 15 or 20, even $25 million fund. But you're really not going to get above 25 million because that's your audience. Now on fund 2 and on fund 3, you can start talking to these sovereign wealth funds, endowments, and other corporations, larger limited partners, and they will invest. And then you can make your fund size larger at that point. But right now, we're seeing tens of millions of dollars a month in LP commitments going through our platform. It dipped at the end of the 2022 and beginning of 2023, and it's back up. So there hasn't been a notable slowdown.
So you think starting a new venture fund requires a background in investing? Could GPs with deep experience as tech operators be good profile to start a new venture fund?
I mean, look, if you, okay, we've launched 300 and roughly 50 firms between Mike and I, both in VC Lab and outside of VC Lab. Not everyone has a deep investing experience, okay? It is not required that you have a deep investing experience, but that will affect your fund size. Larger limited partners, small family offices, medium family offices, large family offices, certain high net worth individuals, they're going to do due diligence on you, right? And if you don't have an investing track record, it's going to be difficult to close those limited partners. So if you don't have an investment experience, you're going to by default have to raise a smaller venture capital fund to start with, because you'll build your track record with the fund, and then you can raise a larger fund in fund 2. So it's not required, but like if you've never angel invested before, it's difficult for us to accept you into VC Lab because they're like, I don't, does this person know how to invest? I don't know. Does this person have a network of deals? I don't know. Does this person have no other investors that they've co-invested with as an angel or whatever that could be limited partners? I don't know. And then and so that makes it, we do accept some, but it makes it harder because when you've done a decent amount of investing, it's kind of like, okay, you know how to invest, you have deal flow, other rich people, makes it easy as an investment, as an admissions decision.
And non-accredited investors start a venture fund. And then there's a question here about showing the back office, but we have 28 minutes, 28
yeah,
questions.
well, if we run out of time or we run out of questions and time zone, yeah, so you don't need, you don't need to be accredited or wealthy to start a venture capital firm. Starting the firm gives you an accredited status. So you become accredited by starting the firm.
What is your take on managers from the CE, Central and Eastern Europe, in the program? How about the accelerator managers in the VC Lab? We have a lot. I mean, a ton in that region. There's also a question here from Thomas too about like how biased is US biases VC Lab. 66% of the alumni of VC Lab are outside the United States. Okay, but venture capital is has a lot of its roots in the United States. So naturally, we try to bring some of those philosophies into the program a little bit, right? But that being said, like most people are not, and we've helped people launch firms in Europe. We've helped people launch firms in Africa. I mean, literally in every corner of the world. We've launched a firm in Mongolia. Okay, so like this is a truly like international audience, and it was like that from the beginning. So hopefully that's helpful for both of you.
Yeah, and so everybody upvote questions. We got lots of questions. We do want to do everything that we can to answer all the questions. As we said, about the halfway mark, people start pouring questions in. So do me a favor, read them and upvote them. Okay, Mike, and you want to archive.
Can I launch a VC fund with my own money? You sort of, but like, look, the minimum fund size for it to be viable, it's like around 2.5 million. If you're domiciling in Delaware, it's 5 million in Canada, and in Europe, it's actually 10 million and above. So, you're gonna put some of your own money in, but you're definitely you're gonna need additional capital for it to be viable.
Yeah, I mean, yeah, right. So there's no such thing as a $500,000 venture fund, right? Because the expenses of running the fund and administrative costs exceed the size of it doesn't make sense. So you really, as Mike said, 2.5 million.
When launching a VC firm, when is the best time to engage an accounting and tax firm? This is,
Yeah, so I'll look,
yeah.
I'm going to be very clear about this. You don't talk to any vendors, all right? And like, if you take anything from this conversation, take this one point. That means no lawyer, no tax, no back office, no CARTA, no nothing, until you have 10% of your fund size committed by limited partners. So you can go now, you can't pitch your fund on the internet or stuff like that. There's general solicitation rules. Mike, if you want to post the general solicitation stuff in the chat. So you have to have pre-existing relationships with wealthy people and then pitch them your fund. And you have to do this even if you talk to a lawyer or whatever, right? So you got to follow the rules, right? Which is why we have an accelerator to help you understand the rules and help you pitch better. You got to follow the rules. You got to get 10% of your fund committed. And then and only then do you talk to a lawyer, back office provider, etc. Otherwise, what you're doing is you're wasting time and wasting money, because they're all going to tell you, oh, you got to get started right now, right? What that you don't need to get started now. They just have a sales quota to meet, right? They're not, they're trying to milk you, right? For cash, right? And so they're going to be like, yeah, you need, oh my God, you should be very afraid and start working with me right now. I'm like, okay. And so then you're going to be racking up $30,000, $50,000, $100,000 in costs, right? Which we've seen many, many times, right? Carta's 75,000 out the gate, right? And you don't have any interest from LPs. So there's no fun. Right. So now all of a sudden you're in the hole, tens of thousands of dollars with nothing to show for it. And you might actually fail and owe the money. This happens all the time. Don't do it until you have 10% of your fund from limited partners committed. Do not talk with them at all.
We have developed a tool. It's called the PACT, to kind of help you to kind of hard circle LPs. This is like a letter of intent that they sign. So until you get 10%+ of the fund in PACT signed, don't even consider talking to a lawyer or
any of these providers. They are not reputable. Okay. They may seem reputable, they may even have a good reputation, but I don't find their business practices reputable, right? At all. I would never work with them, ever. I find them, immoral, unethical, etc. Personally, I would never work with them.
Will the program teach us about the bolts of setting up and running a VC funds? I know about investing and want to support entrepreneurial capital expertise. In my country, there's no VC. Yeah. So first of all, let me take a step back. This isn't a learning program, okay?
Yeah.
This is a closing program. You're expected to do a closing at the end of it, and that's what we're focused on. And if you're not on track, we'll ask you to come back to a future cohort, okay? So this isn't like I'm going to learn about venture capital. But by doing things, you are going to learn a lot. So you're going to learn by doing, right? And yes, we are going to obviously spend a lot of time on making sure that you are setting up everything correctly at the appropriate time, after Adeo just mentioned when the appropriate time is, and we also have additional programs for that as well.
Yeah. What is the optimal number of LPs for a new seed fund focused on deep tech? Like a small $20 million fund. Okay, let's start with $20 million is not a small fund. All right. Everybody here should be thinking of $5 million as their starting fund. If for some reason you're best friends with Elon Musk or whatever, you can think of maybe a 10 or 15. And if you have lots of best friends like Elon Musk, maybe you can go to 20. Okay. I am best friends with Elon Musk. Okay. My first fund, or a fund I just recently launched, I was a new manager because every time you start a new firm, no matter how experienced you are what's called a new manager. You have a scarlet letter on your head. No one talks to you that's has real money. So it's like starting over. And that fund was $5 million. Okay. So you're like, I'm launching a small fund of $20 million. Well, unless you know super wealthy people that are going to write you $1 million checks, where's that money going to come from? Doesn't, like, they're not like LPs sitting around like, oh, I can't wait for this dude who has no experience to give him lots of money. So that doesn't exist. Okay. So you're going to have to go to your friends and ask them for $20 million. So if you happen to know friends that have $20 million and they want to give it to you, then there's a chance you could do a $20 million fund. Otherwise, your fund will be $5 million, or in some cases, 2.5 million, or 10 million, I would say is the most realistic suite. So 5 to 10 million. Okay. Some will be 15 and some will be 20, but those are outliers. And the optimal number of LPs is, you legally in most places, there's a cap, and you don't want to manage that many people. So you want around 30 to 50 LPs, right? So do the math. If you're looking at 30 to 50 LPs and you want to do a $10 million fund, your average is going to be about 200,000 per LP. So if you know lots of friends that can write you $200,000 checks, you should do a $10 million fund. If that's not the case, and you have friends that can write you a $100,000 check, then you're probably targeting a $5 million fund. And I'm just telling you the way it is. It could, could you get lucky and get some money from a LP and make your $5 million fund a $10 million fund, or a $10 million, $20 million fund? Sure, it happens all the time. But you should start with a very realistic expectation and oversubscribe. All right, let's keep rolling.
That being said, the average number of LPs is in the 30s to 40s, and 30 to 40 people, and you don't really want more. Okay. There's like a 5-6 part question. Guys, we can't really do that here, but
we're gonna do this. You're gonna re-break your answer into
let's just
different questions. Let's move on, Mike. We can't.
Will the recording be available? Yes, it will be recording. It will be available. Where does the first investment go if you have not paid legal fees to set up the fund yet?
So here's how it works. There are things called fund expenses. Mike, post the link into the chat.
It's already in the
we
chat.
can do it again. So there are two types of fund expenses. There's something called an organizational expense that's capped, and that's the money that the fund will pay to get set up. It's usually capped at 50 or 100,000, right? If you're a bigger fund, it can go up, but I've never really seen it above 150,000. And sometimes, unfortunately, it can cost you a lot more if you don't manage things correctly. And so that comes out of your pocket if you screw things up. So you have an organizational expense. When you close your fund, that goes to cover the expenses of setting up the fund. There's a second. Fund expenses overall are also for the ongoing operation of the fund. Now, the article we put in there's a lot of things that could be a fund expense that managers don't charge as fund expenses, right? And there's some things that, should always be charged as fund expenses. And so these are fees to run the fund that LPs are expected to pay every year on top of management fees and besides carried interest. So you generally will pay your fund expenses on closing. Let's say you have a 50,000 organizational expense and you call 250,000. Okay. That means that you'll have 200,000 left over because you take the 250, you subtract the 50 organizational expense, and you're left with 200,000. And you have then use that 200,000 to make as many investments as you can. Preferably, we recommend that you do at least 2 and preferably 3 investments with your first close.
Does it mean that if I have no experience investing, I cannot be in the program? I have the funds and the network of deals and other VCs to co-invest. I can hire someone to be a co-GP. So before we go to the co-GP thing, which is not a good idea, Daniela. No, you don't. Like, we've had a lot of people in the program that have a limited number of investing experience, but maybe they run an accelerator or they have some sort of deal flow funnel or something, and they have just demonstrated the ability to at least have the potential to be a good picker of deals. So that's fine. That is just, like I said, we do get a lot of people that apply, and quite a lot of people have had some experience investing. That's number one. So it's not a requirement, but you really do need to have some sort of an edge, some sort of a opportunity, a place to have a lot of deal flow, like being an accelerator leader.
The second part I'll take, Mike. Everybody, stop asking questions. Look at the questions that are there. Use the thumbs up to vote on them so we can answer the best ones. All right. With respect to the second part, you cannot hire someone in a venture capital firm to do important work. Okay. Period. End of story. The way venture capital firms work is you have partners, you have venture partners, and then you have interns, associates, and the like. Okay. Partners, you need to know for at least 5 years and preferably more, as much as a decade. If you don't know someone for 5 years or more, they are not a partner. Okay. They just cannot be. These are 16-year entities. When you set a venture capital fund up, you're going into it for 16 years. 16 years. Okay. So if you don't really know someone, you can't hire someone. Look, I'm hiring you for 16 years. Like, okay. Like, that doesn't exist anymore. Maybe in the 50s that happened, but in 2023, you don't hire someone for 16 years. You know them for a long time, and you're like, I really like this person. I can at least 5 years, and I want to work with them for the next, decade or 2, right? Then it's like, okay, they can be your partner. Otherwise, if someone's super experienced and has lots of knowledge, they can be a venture partner, which is a part-time role. And you can test someone that you might want to work with as a partner by making them a venture partner, putting them part-time. And you can fire venture partners very easily. It's not easy to fire a partner. Okay. And that's another problem. And then last but not least, the rest of your team, especially on Fund 1, are going to be like associates and interns. And so this sort of answers another question: how can I find someone to join? Well, you can either join as a venture partner, and venture partners don't get money, they get carry, right? Or you can join as an associate or an intern, and interns and associates don't get carry, but they get a little bit of cash, right? So that's your path into venture if you're not going to be a partner, right? And if you're interested in being an intern or a venture partner, you can apply on the VC Lab site. There's govclab.com/jobs. Maybe you could put the link in there, Mike. And we have interns and venture partners, and you can, by putting your information there, assuming you're good and there's a match, we will match you with new and emerging managers around the world for that role. But partners, there's no matching. You've got to know a partner for a long time. Okay.
I want to launch a fund. I want to launch a fund in Africa. Which place is better to incorporate the fund or accelerator to be operated from Egypt and investing in Egypt and Africa?
US. Everyone, look. For whatever reason, there's domiciles around the world. Okay, you probably heard of the Caymans, Mauritius, like Luxembourg, Singapore is kind of popular, blah, blah, blah. They all are expensive and suck. Okay. I'm just going to lay it out. What I mean by expensive is if you set a fund up in the US, these other places are 5 to 10 times more expensive on everything to do. And that expense isn't just cost, right? That too, it's also time. So, for example, in the EU, every country in the EU requires that you get an audit, which is tens of $1,000s of a year to do. They require that you file with them and get something called a Uvica in most cases. That takes months or a year and thousands or tens of thousands of dollars to do. Then they have all this regulatory hoopla that they make you go through that just dramatically increases the cost of doing business as a venture capital firm. And that means that you need to have a much larger fund size and much longer time horizons to set those firms and entities up. That includes Moorishes, everything. So basically today, everybody's domiciling in the US unless there's a very specific reason not to. Like Singapore has a lot of laws so that you can't set up a fund in Singapore if you're not in Singapore, and you can't set up a fund anywhere else if you live in Singapore. So Singapore is like, if you want to start a fund in Singapore, you got to do it in Singapore, but it's wicked expensive, crazy expensive. So
and there's a follow-up here from Malcolm on, Mauritius. Mauritius is horrible. Like, do not go to Mauritius, dude. Like,
talk about a kleptocracy. It's like,
yeah, he's like, it only costs $3,000. No. It costs a lot
if
more.
You really want to go slow and spend lots of money to do so and feel like you're like bribing and like in a weird, yeah, great, go there. Sounds like a great idea. No, the US, everyone does the US. Like literally, Mike, I mean, out of
everyone in Africa for sure does it, because all the companies in Africa are going to the US.
Everyone everywhere. I mean, look, I can literally now count in 2022, we started 197 firms. That's half the number of new managers in the world today. Okay. You can probably count on 2 hands the number that are thinking of doing outside the US. Right. It's like, and they have to, because of reasons, whatever. They have a big LP, they live in a place there's no other option, blah, blah, blah. Otherwise, like, it's just, why would you spend all that money? Right. And headache. It's crazy.
I would be curious to hear how narrow of focus the VC lab follows in terms of like the investment thesis. Are more like quote unquote exotic investment thesis welcome, or are there standards like early stage tech representing most of the cohort? Definitely not. I mean, we have obviously a lot of healthcare, life sciences, biotech as well, so that's also part of it. But we have all sorts of models that are coming. That being said, this is for people that are trying to launch venture capital firms, okay? And venture capital is a very distinct style of investment practice. So you are going to be betting on companies that can become very large very, very quickly. And that's what VCs do. Now, if you're trying to do something a little different than that, like I want to exit earlier or that kind of thing, that becomes more like a hedge fund type of situation. And so, that might just not be the right type of fund that we can support.
So if you're interested in learning more, we have a research report. Mike, do you want to put a link to the research report?
Yeah.
And we just looked at about 400 firms that were either in the program or had graduated from the program. And we have all the data on what new managers are doing in that firm and that report. So if you're curious, what does like venture capital new manager firms look like in this was done in 2022, but the kind of the end of 2022. So beginning of 2023, that's a great report. I mean, that's a huge percentage of the market that we have actual data on, like 50%. And actually, since it includes another cohort, it's actually over 50%. All right, let's keep
Yeah,
rolling.
and so bootstrap stuff is fine as long as you want those companies to become very large, because otherwise the model doesn't work. Could you please just briefly explain how the GP commit comes out of capital calls?
Yeah, it's very simple. So if you have a $10 million fund and a 1% GP commit, the GPs, which may be 1, 2, or 3 people, let's say you have 2 GPs that are 50-50. Each GP owes $50,000, right? Now, let's say you do a 20% capital call, which is very common for your first capital call. Well, 20% of $50,000 is $10,000. So you owe $10,000 on the first capital call, right? Now you'll do another capital call, probably a few months later, maybe for another 20%. So again, it's whatever the 1% of 10 million is 50,000, and then you'll have it's a little more complicated. I oversimplified there because you usually don't close on the full 10 million. You'll close on a lesser amount. So let's say you close on $5 million, so you only have half of it, and so it's not calculated off the full 10 million. It's calculated off whatever you close on. So if in fact you close on $5 million, the 1% is 50,000. It gets split between the two partners to 25,000. You call 20%, that's $5,000, right? So that's how it works essentially. And hopefully I kind of over explained it, which may have made it sound complicated, but it follows the same capital call structure that all your limited partners also use.
Have you had any experience with evergreen funds versus closed-end funds in the
Yeah,
venture
they
industry?
suck. Don't do them.
Yeah.
Terrible idea. Like evergreen funds, bad idea. All right. People are like, Sequoia is doing an evergreen fund. Okay. Sequoia is not doing an evergreen fund. That's like, I don't know what, like that was Sequoia is doing some fund to take assets from their normal funds that they don't want to sell because they think the company is going to go public or whatever. And it looks like an evergreen fund, and the media is like, look, they're doing an evergreen fund. Remember, media and venture is not true. Okay, it's wrong. So if you read something in the media about venture capital, it's often wrong. So evergreen funds, no one's figured out how to do them, Sequoia included. Anyone that's trying them is like kind of not really winning right now. They're doing, the best ones are doing okay. And if you tell me you want to do an evergreen fund, so what's going to happen is you're like, dear limited partner, I'm doing an evergreen fund. And they're going to be like, what's that? And they're like, it's this thing and it works like this. They're like, tell me more. Well, okay. So then when you take money, it goes like this. Let me tell you more. What are you doing at that point? You're telling them about some weird evergreen model and not your thesis. And so they're going to ask you hundreds of questions about this weird fun model and nothing about your thesis. So you'll spend hours and hours and hours with an LP educating them on a model that basically doesn't really work. And then they're going to be like, well, thanks for the free education. I'm not investing. And if that's what you want your life to be for the next few years, sounds great to me, but I want nothing to do with it, right, Mike?
And it's poorly aligned with the venture capital in general, right? Because you have these companies that need to exit in like 10, 12, 13 years, and there's not going to be liquidity. If people are trading in and out, it's just like an absolute mess, right? So it's just like really difficult to make it work. Okay, what are the primary skills attributes you guys are looking for when evaluating funds for the program?
Look, so we have an admissions process, and following this meeting, I have an admissions meeting actually to discuss this. And so we look at a lot of different things. So I'll go through some of them for you right now, if you hold on one second. So first and foremost, we want to make sure you have a strong network, right? Because venture is a networking business, right? So if you don't have a strong network, there's simply no way that you're going to be able to launch a venture capital firm. So the easiest way that we measure your network is the number of LinkedIn connections. If you don't have at least 1,000 LinkedIn connections, you're going to have trouble launching a VC firm in our experience. So we like to see thousands of LinkedIn connections. Then we look at your background. If you're trying to launch a fund in deep tech, but you have no deep tech experience, that's not great. If you have no angel investing experience, that's not great. So we look at your actual experience and try to say, do you have relevant experience to what you're trying to do? Do you have any investing experience of note that you can, that's useful here? We look at your thesis. Is it viable? If you're trying to launch $100 million fund in Africa you're never going to do it. Okay. I can just tell you right now, not a chance in hell. So like Mike and I would have to come in and spend time with you to correct, like, no, I can do $100 million fund. No, you can't do $100 million fund. No, I can. Okay, I'm not fighting with you over something that we know is impossible, because we work with managers in this field all the time who have failed trying to do much smaller funds with a better reputation. And yet you're going to be the one to do it. Unlikely. So your thesis has to be realistic. If it's not realistic, then it's not worth Mike and I fighting with you. Then we look at, like, what do you need and what time do you have? Okay. I'm going to launch a $20 million fund. I can put 10 hours a week in. Okay. No, you can't. Right. This is like, you just can't. Like, you think you can, which is great. You can think whatever you want. I'm not trying to change your mind, but I don't want to spend time with you if you're actually trying to launch a $20 million fund and you have 10 hours a week, right? It's just not going to happen, right? It might happen, right? Santa might exist, but I'm not sure that Santa does exist. So if Santa doesn't exist, very unlikely 10 hours a week, you're going to launch a $20 million fund. And then we look at your video, because you're going to be pitching LPs on video all the time. So if you don't look professional, if you can't present yourself well on video, and it doesn't look, I didn't prepare for this. Like, I shaved ish this morning, but I didn't prepare. So if I can come on and look professional and talk like I sound like I know what I'm talking about, you can too. And if you can't, if you're in a t-shirt on a gym machine or whatever, and this is how you're going to represent yourself to LPs, it's not a good fit, right? So that's everything we look for in a nutshell.
Law with zero taxes and no capital gains tax. It's super early days, Rodrigo. It's not a viable place right now to launch a venture capital firm, maybe in a few years. What is the dry powder portion we should keep for follow-on investments?
Yes, so that's not called dry powder, by the way. That's called follow-on reserves. Most new managers on Fund One do not have any money for follow-on reserves. So you have to go in with that assumption on Fund One. Now, that doesn't mean that you could have a strategy with a $5 million fund and do like 10, 25,000 or 20, $25,000 investments, and then the rest for follow-on in a few. So you can have a strategy that has follow-on reserves, but given the fact that most new managers have to have a smaller fund size, they don't have follow-on reserves.
Are you seeing any industry shifts in the 2 and 20 model?
No, everyone does 2 and 20. The reason isn't that it's necessarily the best model. It's a very good model for funds under 100 million. It's 2 and 20 becomes kind of bad when you get much over 100 million, so 200 million plus. It's like, it's kind of not a great model, because that 2%, I mean, you're just, yeah, it's not good. You've got like VCs getting paid $5-10 million a year, and then they don't really care about carried interest because they're making $5 to $10 million a year from the two, right? So the 2 and 20 model does work very well for funds at like around 100 and under. And as a result, and it's well understood by everybody. So like when you do something that's not 2 and 20, you have to go explain yourself. And then you spend time in a meeting with a limited partner explaining why you're not 2 and 20 versus telling them about what you're trying to do with your thesis and investment strategy. And that's a giant waste of time. So everybody does 2 and 20. And you know, there'll be a time where maybe we can refine the model beyond that. But as I said, for funds at 100 million and less, it's a great model.
Can you talk about the cost and benefits of having a seed investor in the GP versus finding an anchor LP? Like none of those are good. Okay. So no seed investor in the GP because they're like trying to take a piece of your carry. They shouldn't need that. It's actually not a good place for them to be. What they should be is in the LP. And finding an anchor LP, like people don't have anchors in fund ones anymore. Like that's like not realistic.
Again, read the internet on anchor LPs. Oh, anchors are great. Like, okay, like internet reading and venture equals the pit of death. You will learn everything wrong or not to do. So let me just go into this one more time, okay? So why is it wrong? We talked about people not knowing blah, 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 but there's another reason why it's not wrong, why it is wrong, okay? Venture's broken. Like, why don't you, if you read anything on the internet and it talks about how venture's being done today, it almost by default is broken because venture capital is broken. It's misogynistic. It's run largely by white men, and it funds things that don't matter. So you can get a rule book on things that not to do by reading about it because it's written by the practitioners that are unethical, etc. Right? And I'm going to be generous right now. So really skip that stuff. Anchors they're not common anymore. They happen sometimes in later funds, but Mike, have we even had one anchor in the 300 some odd funds? Maybe
one.
Something like that out of 300 funds, over 300 funds. Yeah, anchors don't exist anymore.
Yeah, and you don't want to take investment in the GP. Is it considered general solicitation if I put "Are you an investor? Let's talk" on the website of the fund?
Yeah, absolutely. That is exactly general solicitation. Let me be clear, everybody. If you have a website for your fund and it is not 100% closed, you must take it down right now. Okay, not tomorrow. And by the way, if it's up and you received an investor lead from it, you're probably going to have to change your thesis, okay? In the EU, they put you in jail. In the US, the SEC will come after you and you can be banned. The penalty is banned from all fundraising, bake sales, companies, any fundraising for 10 years. Okay, so the penalties of I think general solicitation laws suck. Okay, so I'm not here being like, you know, follow the law. These are good laws. No, these laws are terrible and they're written really badly and they're super confusing. But you need to only pitch people that you know and people that are wealthy. If you follow those two guidelines, that covers you in most of the world. There's slight differences in the EU. There's slight differences in the US. I am not a lawyer. I'm not giving you legal advice. But I can tell you that if you're posting on social about your fund, if you have a fund website, take it down right now. Down, off, delete. The risk, reward, like maybe you get an LP from it, woohoo, or you get in trouble with the law. Like, you know, not worth it. So in the program in VC Lab, we take you through step by step on how to cultivate relationships with LPs, blah, 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 blah. It's not that hard. That article we shared covers some advice as well, but you got to be super careful on this, okay? And that question is a perfect example. And that's why we tell you, don't share your thesis in the chat. you can talk about what you're interested in. You can share your LinkedIn. You can say, what if you've invested in companies, you say, I've invested in these things. I'm very interested in deep tech, but you cannot share your fund thesis publicly.
Awesome. Well, we've reached the top of the hour, Adeo. So
I know we have another meeting. Should we do? All right, I'll leave you. This was great. Here's what I recommend. If you go, I'm going to put on LinkedIn, and maybe you could share my LinkedIn, Mike, shortly after this call. In fact, I'll do it as soon as we hang up before I jump on my admissions call. I'll put a post up. You can put your questions that were not answered here on that post, and I will answer them in text, because we're here to help, right? We look, we can turn venture capital into an asset class that we are proud of, that is making the changes in the world that we want to see, that is making the world a better place. We can do that. We are doing that, right? And then we can look around at cities that take in carbon versus produce carbon, at cars that are electric, at jobs that don't force you to travel an hour each way to go to. We can build a better future through venture capital, and we're going to help do that at VC Lab. That's why we do it. We don't do it for the money. We don't do it for any other reason than to make the world a better place. That's why our programs are free. The software is free, and we will help you as much as we can to succeed. So thank you so much. Look for my post in a few minutes. Get your questions there. I will personally answer them. It may take me a day or so, but I will answer everyone's question.
Thank you, everyone. We will be sharing the recording with you as well. And if you're, again, interested in launching a venture capital firm, please go to govclab.com and submit an application. The early deadline is this weekend.
Yeah.
And the folks that come in through the early deadline just get a much higher priority just because we have way more time. We get slammed with admissions towards the end.
Yeah,
so
we'll have a few thousand people apply. Last time we had 2,740. Right now we have about 900, right? So your odds of getting in now are much better. All right, everyone.
Bye, everyone.